The dragon has awakened from its slumber this year. China has reopened, and we're all already feeling the effects in Singapore. If you've been to the night safari recently, like I have, you'll know China is back and they are going out into the world. Chinese tourists are spending. Their revenge travel is real. But what about their businesses? To tell us more, I'll be speaking with two very distinguished gentlemen with expert knowledge of the East Asian region. Please welcome on stage Mr. Lim Yuin and Mr. Colin Ng. So, Mr. Lim Yuin is the Chief Investment Strategist at Lion Global. Mr. Colin Ng, the Head of Asia Equities at UOB Asset Management. Yeah. Thank you for joining us. Could I trouble each of you to just give a brief introduction of yourself?
Hi, good morning. I'm Chief Investment Strategist at Lion Global Investors. I've been in this industry for, I should say, around 15 years, 3 years at the sell side, doing research for a brokerage firm, CLSA. I think some of you guys would know the firm itself. And the last 13 years here at Lion Global Investors. So I used to manage also with my co-fund manager, Japan fund. Also, I was a fund manager for a global disruptive innovation fund for the last 6 years or so. And before that, if you work out the math, then you say, 15, 16 years, it looks pretty old for that number of years of experience. But actually, I spent another 8 years at the EDB because I got a scholarship from PSC. I think Singaporeans would be quite aware of the system here, bonded to the government, and I spent three years in Tokyo for the EDB, and then I started traveling around with CLSA in Japan and Hong Kong. Then before settling back in Singapore again. Yeah, so that's my experience. Lion Global, I think you guys would be familiar with. It's part of the OCBC Group. It manages bonds, equities mainly, and we are more or less an Asian house, sort of. Yeah. So the AUM is around 67 billion Sing dollars, thereabout. Thank you.
That's a very, very humble way of talking about a very big number right there. So he's got a wealth of knowledge, obviously, both in the public and the private sector, as well as across East Asia. Thank you for that. Colin.
Thanks for having me. Good morning. I'm Colin. I'm from UOB Asset Management. I basically look at the Asian equities across Asia. I have been, in terms of investment experience, I would say, 28 years, looking at stock markets. And prior to, I work in UOB as an analyst. Then sometime, in my mid-career crisis, I think so, I went to work in Hong Kong for 4 years. So really kicking the tires in the Hong Kong, China stock market. And I returned back to Singapore back in 2012. And then basically another 10 years, with UOB Asset Management. So I'm very happy to join you, and hopefully, I can share my thoughts and my insights, on the Chinese market to all of you all. Thanks.
Thanks very much. We'll stay with Colin. Since you just spoke, I think you've been through crisis, so many different crises throughout your career.
Yeah.
And it feels like we're going right into another big one right now. We're sliding right into it. We're going to focus on China, though.
Okay.
All right. And this week, the big news was that Singapore was represented in America because the Congress was grilling Mr. Xu about TikTok.
Okay.
He's the TikTok CEO. Yeah. So China very much spotlighted. But is that what you find most interesting about China right now, the tech sector? Or is there something else you find most interesting about China?
Okay, put it that way is that I don't really normally look at geopolitics and study, between China and US at the earlier part of my career. Basically, it all started, to be very concerned with geopolitical situation back when the start of the US-China trade war, and that's in 2018. And then, of course, what we saw last year was the Russia-Ukraine war, which actually has implications to China as well. As you can see also last week, we saw China coming out to be the peacemaker. So all these are basically chess game, that you have to also understand, the whole development as what we term as, from a unipolar world to a multipolar world. And this is the change that probably, Xi Jinping was highlighting that over the next, this is a change that probably is the CEO for the past 100 years. Of course, in all geopolitics, when the number one is hitting the number two will surely feel very painful. And in this case, China is the poor number two being hit at every time on import constraint, like for example, the exports tariff that we saw back in the trade war, and then now the US-China tech war as well. And lately, go into company-specific like TikTok or even Huawei, for example, back in 2019. By the way, Huawei is still surviving, despite a whole country banning, a company like Huawei. But I believe the interesting thing is that how we see China evolve, and recently I also noticed that the Chinese president is actually outwardly pointing that US will be an adversary. So meaning that, you will have this kind of geopolitical move that is actually pretty interesting to me, because I cannot really second guess what's their next move. But all these political leaders are doing a chess game like a chessboard game where they can actually anticipate what's the next 3-4 steps ahead. But more importantly for stock market is that I think the differentiation here is that while inflation is a US and European problem, or likely the Western world problem, China does not have an inflation problem. So in fact, what happens is that China has been reducing interest rates, and that is actually a big difference. Meaning that there isn't so much financial stress on, for example, the property market, which is also one of the concerns, which we can further elaborate. Maybe I'll stop here right now, but I actually see a lot of interesting development in China over the next 5-10 years.
Yeah, we can't get away from geopolitics right now. And I think we all forget that balloon thing actually happened recently. It was the biggest news. They actually fired a $400,000 missile at a balloon, and the first one missed. So, and it was big news, and then suddenly now we seem to have all forgotten about it. So I'm going to go on to let you know, what do you see most interesting in China right now?
Actually, I want to add on to just now that discussion, right? About geopolitics and things like that. When I look at the audience over here, I sort of wanted to put it in a different perspective, meaning that, for example, right, when I have dinners with my mother-in-law, right, and then they are stock investors, sort of, so they ask, hey, all these things that are happening, should I be worried? Should I sell now? Should I buy this? Should I buy that? So maybe, I put it in this perspective, right? You guys are all very busy people, right? Then you read the news, you watch it. Oh, spy balloon. Oh, then should I sell, right? The next moment you see, Xi Jinping with Russia, then you worry that, are they going to have some kind of a conspiracy? They're going to provide some weapons to Russia, and as such, China might get embargoed and so on and so forth. So all these worries about things, right? I think for geopolitics, the important thing as a strategist or as an investor, right? Because we manage money on a full-time basis, is this: look at the event, don't care whether it's right or wrong, right? Don't care whether it should be this way or should be that way. It has happened. The next question you ask yourself, is this actually applicable to investment? So what do I mean by that? Let's say tomorrow North Korea launches a missile across the streets, and then it lands somewhere in the water. There's a lot of noise, and then the stock market comes down for a couple of days or so. Should you be worried? right? Actually, in a longer term basis, when I say longer term, I don't ask you to wait for too long, right? Maybe in a few weeks' time, you realize that the share price comes back to the same level again. Then you get whipsawed, right? Because you got worried, you sell, and then the next moment, when you rally, you say, I missed it. Then you say, what is all these issues? So that's a standard mistakes that investors make. That means you react to news, the wrong news, and you get whipsawed, meaning you lose money. You buy and sell at the wrong time. So what are the things that you should look out for? And you say, then how is this relevant? How are all these geopolitics relevant to investment? Actually, by rule of thumb, this thing has been sort of like researched a lot by the sell side. Your UBS and what have you. I've read reports on that, and it goes back historically, a lot of events, and they work it out. So for things that actually will have an impact, so this is where it is, on two things. One, which is the policies. So when I say policies, it means the monetary, fiscal policies of the government. Why is that the case? It's because if you lower interest rate, right, asset prices goes up. Or if the government spends more money, that means they increases the fiscal spending. Then the economy becomes hotter, right? Then companies make more money, and it's actually better for stock market. So that's why you see when it comes to election, right? People, investors actually do focus on it a lot. But things like, that if there's some skirmish somewhere, some, human rights issue somewhere, or spy balloon, or what have you, that doesn't change the fundamentals of the company. So that, to me, I think is good to discuss, right? It might affect one or two stocks. In this case, let's say TikTok. It impacts TikTok and the surrounding companies, but in general, it doesn't impact the whole sector itself. It doesn't impact the whole economy. So this is the first thing that you should look out for. Does it impact the policies that the governments are putting out? So that's the first thing that you got to remember. The second thing you'll remember, does it impact oil prices? Then you ask why oil prices? It's because oil price has a huge impact on consumption. So can you imagine, let's say, if there's a war in the Middle East, and then oil prices shoots up. Historically, it's been proven, right? Oil shock, oil prices goes up, inflation, right? Then the government has to do something, they raise interest rates, right? Then after the economy tanks, and then, so it does impact the share prices. So all this discussion about TikTok, maybe some guy get arrested or what have you, to me, it's good to discuss, right? But it really doesn't impact the fundamentals of the market itself. Okay, so then the second part, what am I interested about now at this moment for China itself? I think we are at a pivotal moment. This is a very interesting time, right? I think COVID has sort of synchronized the growth reopening in the developed markets. So now it's a time whereby the world is split into half. Can you imagine? China is decoupling because of these trade wars and whatever, that they have. But at the same time, because of the way they chose how they react to COVID, they are just reopening this year. So look at hard numbers. The consensus numbers for developed markets this year, US, Europe, Japan. What is the economic growth rate? I ask you. Go back, Google. Some optimistic guys will say 0.5%, maybe 1%. Some say that there's a hard landing, maybe it's a negative growth rate. Whatever it is, let's say 0, right? What is China telling you now? China is telling you, I'm reopening, I'm going to loosen on my policies, right? And I'm going to boost, because last year my GDP growth rate is 3%. This year I'm going to target 5%. They say that there's a regime change. They say that, right? If you are the new regime, what would you do? You will focus your efforts to achieve this 5% growth rate. I think this 5% growth target is actually a flaw. They have set themselves a target that's easy to achieve. So now you ask yourself, look, US, Europe, Japan, 0% GDP growth. China, 5%. There's a differential of 5%. And at the same time, in US, Europe, they have tightened interest rate. They are now having maybe stress in the system. They see bank runs and so on and so forth. But in China, it's a reverse, right? You have a situation whereby they're just getting out of lockdown, right? You look at the consumption numbers this time around in January, February, starting to turn up. Property numbers are starting to recover in January, February. Go back and look at that. So you have a world that's split in half, one that is slowing down, one that is moving ahead. The only thing that investors can push back is this. Historically, when the US catches a cold, right? If the stock market in US drops, crashes because, let's say, if there's a credit crisis, the banking crisis, the rest of the equity markets also gets dragged down. But in this case, I think we are in very interesting times because the growth differential between the developed markets and China is so different that we think there's a case to be made to be more bullish on the Chinese market. I'll stop here.
Wow, thank you for laying out the bull case for China. Wow, that's very compelling, actually. I'm going to go back to Colin on this one. So that said, having heard that, Colin, on your side, where do you think the best opportunities are in China right now? Which sectors or which areas?
Okay, sure. I think just to add on, last year's China GDP were at 3%. That was because it was negatively impacted by unexpected lockdowns in Shanghai, in Shenzhen. But this year, on the 8th of January, everything changes because businesses would not have to worry about unexpected or sudden lockdowns. That means business as usual. It's like back in Singapore, business is as usual. And not only that, is that, in Singapore, we have all this, you have to, what you call that? You have to enter your restriction, your mobile phone to get, I can't even remember the app because I haven't used it. Trace Together. I mean, in China, basically, it's a relief for them. So meaning that they can actually travel all around various parts of China. Okay, while I do agree that, 5% is a lowball target for China, the fact is that the external environment is likely to be challenged because of weakness in US and Europe in terms of economy. And therefore, the external front might be affected because if Europe or US goes into a slowdown, the orders that they will dish out to China will be also lower. And in that aspect, I would believe that the service and consumer sector will be the sector that will propel the growth for China, at least for this year coming. And it's certainly very interesting is that therefore, you look at all the consumer stocks, the service sector stocks, they are actually looking at pretty good, in terms of corporate earnings growth going forward. But I actually believe that in China, when you invest in China, what is the competitive edge for China right now? We used to look at China, I used to look at China for many years, and all you guys also would know that when you buy Chinese goods, it's actually very cheap. So the price competitive edge is there. But 10 years ago, China doesn't have the quality. But right now, China comes in with quality. So, for example, the best app in US is Temu. It's a US app. It's a Chinese app might be the next to be banned.
This is the Pinduoduo one, is it?
Yeah, Temu. And then you got Shein, which is a fashion, could be banned also because of TikTok. If every Chinese app cannot operate in US, then likelihood that they can be banned. But what I'm trying to highlight here is that, companies are able to produce at quality and with scale, meaning that you are price competitive. Where I also think that China has a leading advantage is in its green energy industrial complex. Why I say that is that if your belief that over the next 5-10 years, if all governments is to push to save the environment, go for green energy. Unfortunately, here is that China, or maybe fortunately, due to the strategic planning, is that China is very dominant in the green energy industrial complex. Why I say that is that if you look at the EV battery space, China has, I would say, 7 out of the top 10 EV battery producers, meaning that they hold on to it, and how they get so dominant is that actually it was over, I would say, it's not like last 2-3 years. They planned this for the last 10 years. Together with the Belt and Road Initiative, they're able to secure a lot of resources from Africa, even from Indonesia, for example, because they have good relationship with them, helping them with infrastructure, and therefore have a win-win situation in securing the materials. But not only in EVs, the point here is that if you look at Europe and US, they are so far behind in terms of lithium or all your battery manufacturing capability, which means that over the next 5-10 years, they really have to push a lot. The US really have to push, Europe have to push to do this. Else, you always will be reliant on China. And not only China is strong in EVs. If you want solar batteries, our house, you want to have solar panels, China is 90% across all the various supply chain of the solar panel. Meaning, right from polysilicon to the panel, everything to the wafer, again, China is dominant. And China can sell it cheap, And you look at wind power energy, China is also, 7 out of the top 10 producers are from China. The point is that, you all heard about rare earth, right? Industrial magnets, you need rare earth elements, and China basically is, dominant with 85% of the production of rare earth elements. And in that sense, actually, that provides us with a lot of investment opportunity across this spectrum. At the end of the day, even if the world, economic cycles are in cycles, but there will be certain industries that will be underpinned by this kind of changes. Green energy transition will certainly, if you invest in China, you basically invest in the future because China is so dominant in this area. And I would say it's very unlikely to see China losing that competitive edge, at least in the green energy industrial complex. Yep. Thanks.
Can I add to that?
Yes, absolutely. Please.
Yes, because yes, he has a lot of wisdom over there. So I thought maybe, let me summarize my thoughts very quickly so that I don't waste too much of your time. I think 2 things, right? First thing, thematically, then you think about it, right? If the whole world is slowing down, right? So meaning that what you want to avoid is Chinese companies that are only selling out, correct? Because, outside business is not great, right? So you want to focus on companies where it's driven by internal growth. So domestic growth and what have you, right? So there are some consumption companies that you can look at, right? So just now, I think the previous speaker, I was sitting there listening to him. I think he has a lot of wisdoms over there. Today, you have a lot of materials, a lot of resources at your hands. So you can do your own research. But, bear in mind, right? There's this broad picture out there. So when you read your research, then you think, how does this what they are actually recommending to you, how does it fit into the story, the current story itself? Minding there's always a time frame, right? So my time frame, when I look at things, is usually 6 to 12 months, I think max, because beyond that, I think most people have little confidence, or should I say patience to do that. So first thing is actually to look at this macro picture. Outside slowing, China reopening, growth is there. So look for domestic growth, right? So that's one thing. Second thing that you look for, which dovetails into what Colin has been explaining to you guys, is look for things that have policy tailwinds. When I say policy tailwinds means, obviously don't go and look for things where the government is going to suppress you, right? Those that have tailwinds means the government is actually supporting it. Why is that the case? I mean, look, it's so simple, right? In US, when they talk about trade war, technology war, they're going to clamp down, no more chips for you, and so on and so forth. What are the Chinese doing? They are not, okay, so the good thing is that they're not retaliating by being nasty, right? Because they feel that they still need the foreign companies to be in China, but they retaliate by giving a lot of subsidies and grants. So there'll be segments. So when you say broad stroke, technology is no good, that's not true. You have to look at the segments themselves, because there are some technologies space where they are actually benefiting from the policy tailwinds, right? And they are not caught up in all these, trade, or should I say technology war with the US. They're not being embargoed. So I guess those that are being hit, avoid them. Those that are not, they are getting some kind of a policy tailwind, and so be it. So just now Colin has actually mentioned, right? Green energy. If they are going green, because pump money into it, there'll be segments or companies that actually benefit from it. You talk about EVs. I mean, that's an inevitable trend, right? So things are going that way. So the battery guys are actually doing well. The Chinese have a stranglehold over there. So some of these rare earth and things like that is also used in that area, and so on and so forth. So there'll be segments that actually benefit. So the key thing to remember is this: is there a policy tailwind over there? So my time frame is 6 to 12 months. Yeah.
Thank you for that. Much appreciated. We've got about 17 minutes for your questions. Please do submit them on Pigeonhole, and do vote for the questions also that you would like answered the most. Remember, the top 3 win $50 vouchers. First question, tech has been smashed. Colin, I'm going to ask you about this. Tech has been smashed globally, not just in China. China, of course, a couple of years back, it started with Jack Ma saying things he shouldn't have said, and the China government, there was a bit of a backlash there. Jack Ma used to be one of the most prominent Chinese businessmen in the world. He's disappeared practically from the public eye. And with him, Chinese tech companies also saw a very great decline. That said, the question here from Ing, are they still worth investing in? Will they be coming back upwards?
Okay, thanks for the questions. I think investors has been a bit beaten back in 2021 and also as well as 22. I believe you are referring to the large e-commerce internet companies. Yes, indeed, during the regulatory crackdown that we saw back in 2021, a lot of all these companies suddenly were, they have to make some changes to their business model, with also special attention to data security. But I would say that there is a big change, back in December of last year, is that the central Chinese government actually came out with a policy that going to 2023 this year, together with the opening up of the Chinese economy, China government highlighted that they are going to be more pro-business. So, you're thinking that, will there be another regulatory crackdown, etc.? I think you can allay that fears, at least for the time being, because, again, a bit of geopolitical tension here is that, implication here is that as China is to face US over the coming 12 months, maybe even more than that, maybe in the next 5-10 years, they want to be strong internally. Why hit themselves and weaken themselves, right? They have to be strong internally to face a bigger opponent, which is a competitive opponent right now. I would say that valuations are looking all right. The only thing is that, because of the China-US geopolitical tension, like for example, you earlier say whether it's a spy balloon or weather balloon, doesn't matter. What happens is that the relations between US and China basically went south, like the balloon following or the bubble being burst. We saw was like this reopening that we saw beginning of the year. We saw, China is really coming back. And it was what we were also thinking, China is coming back. But however, because of the geopolitical situation, the valuation accorded to Chinese equities suddenly reduced. So while China is trying to move from 10 times PE back to 12 times to 15 times, Unfortunately, I think because of the ongoing geopolitics, it's likely that China equities will trade between 8 to 12 times or 8 to 13 times. It will not be a case where you'll be accorded a so-called normal market valuation. I just cite you an example. Like for example, in Korea, you noted that Korean stocks actually trade at very low single-digit PE. It's between 8 to 10 times. Whether you talk about Samsung or all these LG, all these Korean companies, they call it the chaebol discount. So meaning that, because you got all your holding structure, investors doesn't like it, but I'll still accord you a valuation. But that doesn't mean that stocks, you still can make money from the stock market, just that you cannot make one bagger or 50%, but you still can make money out of it. I think as what we also agreed, the policy-wise is really what we are also looking out as well. Okay, in the China, we talk about tech companies, I have to bring, my view on the US-China tech war is all out, so that US can suppress, we are talking about this is a hardware part, to suppress China's advancement in AI computing, quantum computing AI, 6G technology, and all this needs advanced chips. And advanced chips is where China, because of globalization over the last 20 years, is actually not their strength. So, SMIC, their largest, their so-called Chinese best semiconductor manufacturer, are able to produce 7 nanometer. Okay? Intel produces 7 nanometer. So they are not far back behind, you see. But it's where TSMC, which is a Taiwanese company that can produce 5 nanometer and going to 3 nanometer next year. I think that is where the concern is, as US suppresses this. To me is that it's a matter of time. Of course, in the near term, those areas like AI, maybe 6G telecommunication, quantum computing, those areas of advancement may be suppressed, no doubt about it, because you would not have access to advanced chips, you see. And this is the area where I think China is, as a country, they are putting all the resources in. It's too early to say that, unlike in 1990s, Japan was really a victim of all this suppression. But China, one good thing is that with the huge population they have, they also have huge talent, the huge talent pool. And together with capital support, money, I'm sure they can make a breakthrough. Whether is it next 3 years, 5 years, but certainly if China is to come out, if they're able to produce a state-of-the-art advanced technology, that will also means that, because as I highlighted, when China do it, they do it with scale and do it cheaply. That basically means that they can sell to the rest of the world with their product. And that's actually, I would say, looking very interesting as well. Right. So hardware, software,
Thanks, Colin. I'm going to move on to the next question because this one is right up your alley. I'm so glad you asked this, Bei. So with the volatility of individual Chinese stocks, is it better to look at ETFs? What is some of the risks and what are the benefits of looking at ETFs instead when you talk about investing in China?
I think, generally ETFs give you a so-called diversification impact, right? So for example, if you buy something like, let's say, China leaders ETF, then you get access to, 50, 60, 70 stocks. And then it's all, I guess, predetermined for you and in a particular weightage, right? So in a way, if you are bullish on the Chinese market as a whole, then you want something that gives you the beta, investors we call it beta, right? Then you buy something like that, meaning that if the whole market goes up, you buy this, it's a cheap way to diversify yourself, and then you don't have to do too much homework. Then of course, actually these days, Actually, in the ETF world, there is the specialized ETFs, right? So you can also focus on things like, let's say, a technology sector. So just now, I think, is it time to buy the tech stocks and what have you, right? But the Chinese tech stocks have dropped for the last, 2 years, 3 years, and then now you are at a stage whereby the Chinese government is telling you we are reversing, meaning that, the regulations that we put in place are mostly adequate. We are almost done, meaning that this discount could actually be, be over, meaning that they could actually price up. And so if you have a bullish view on the tech space in China, then, you can consider something that's more narrow, right? So let's say Hang Seng Tech ETF. So if you think of that, then it gives you a easy way to buy a basket of tech stocks. Then you don't have to worry about single stock names. So there are always pros and cons. So on this side is for people who feels that I got the general picture correct, but I'm not going to do stock picking specific stocks, right? But if you're somebody with a lot of time, right, with a lot of interest and you read a lot, and I want to focus that you have to do your homework, right? Then you might want to do stock picking. So boils back to just now that the discussion about tech stocks. Actually, from investors' point of view, we really hate to say, generally, it will all go up, or generally, because if you look on an individual basis, actually there are these differences, right? So just now, if you say tech, I think most investors will think about Tencent, Baba, or TT and all these guys. They are mostly in that category, right? But if you think about it, I mean, they came from a very high base, they dropped down. The regulatory risks are mostly over. I guess it's mostly done for them. But the second question that you need to ask is, are the fundamentals there really that great? And so this is a question that you have to ask yourself. So if you want to do stock picking, then you have to go to that level. Then just how I mentioned, right, there's a policy tailwind. So in a world of policy tailwinds, the Chinese government is so keen on hardware. So they'll be giving subsidies and grants and what have you to the hardware companies. But then again, these might be companies that you're not so familiar with. But if you do your homework and you say that, this hardware company is going to benefit from the so-called policy tailwinds, the subsidies that they're going to dish out, then so be it, right? So then you could actually do better if you can do your stock picking, pick a few stocks and then, hold on to it. But of course, you have to watch it like a hawk, right? Because if things happen, right, you better know your thesis, right? And you better be aware of the changes in the fundamentals and be ready to react accordingly. Yeah, thanks.
Thanks for that. And if you want to find out more about Lion Global's Hang Seng Tech ETF, they've got a booth outside. Don't put all your eggs in one basket, folks, if you don't have to. I don't think you'll be very happy if suddenly the boss of that company gets arrested. Wah, jialat. So, I think we have time for one final question. I'm going to start with Colin on this one. We're going to combine two questions. We really talked about relationship between US and China. Let's talk about the property and banking. Those are two very closely linked things in China, because the property firms in China have serious liquidity issues. This has been swept under the carpet a bit, but are they coming back up right now? I mean, I wouldn't buy Evergrande right now. It would still make me very nervous. But is there a possibility that this problem is being fixed? And what's the way forward here? I'm going to ask Colin to start with this one.
Okay, put it that way is that the Chinese real estate market has been an issue. Huge leverage by some of these players like China Evergrande. This started back in, I would say, June of 2021. So now we are March 2023. It has been a long time. And I would say that there was a few notable, policies. The Chinese government didn't want to help all these reckless, highly leveraged property developer, and they are privately owned anyway. So some of them actually, several of the high-profile names have gone bust. And what happens here is that finally, I think back in November of last year, the Chinese central bank governor Yi Gang, basically highlights that he wants to engineer a soft landing for the property sector. The only good thing, as I highlight at the onset of my presentation, is that China doesn't have an inflation problem. So meaning that interest rates are actually being reduced. And if lower interest rates, we have less financial stress on potential buyer. But that said, they have to fix the problem of delivery of unfinished property units, no doubt about that. And that has led to, I believe you're all probably aware of it, a nationwide kind of mortgage strikes, stop paying mortgage. But the point here is that, with all these measures in place and the Chinese government trying to push for some of these developers to complete their unfinished units to be delivered to the home buyers, and then the home buyers have to service their loans. Right now, I think they need not service their loans, because the units are not completed. So we have this thing called a standstill for a period of time right now. But as we go approaching into the second half of this year, so I believe that once you get units completed, then you got a bit of resolution of this property situation. It's important because mortgage consumer loan accounts for like almost 28% of the Chinese overall bank book. They cannot have this being negatively impacted. The exposure towards for banks, exposure towards lending to property developer is only about 7-8%. So it's not a big deal for property developer. And we are saying not all the property developers are failing. Only a few are failing. But the key here is that as long as the mortgage segment is protected, then the banks will not have a problem,
hopefully there's no contagion
like in US
because it started with one and the whole house of cards fell down, right? Yeah.
So in that sense, I would say that have a bit more patience on it. We are also monitoring the whole transaction volumes to see when is a good time. Probably not to buy into Evergrande, but other property developers that have stronger balance sheet strength, maybe some of the state-owned ones. Because eventually, for Chinese people, they really want to invest in, first thing is to invest in a property, and with low interest rates, at least for the foreseeable future in China, then at least they are not affecting affordability. I think that is very important.
Thanks very much, Colin. Yuin, I'm going to give you the final word.
Okay, I'll be fast about it. So I think Colin has sort of explained the situation. I do agree with him. I think in China, one thing you have to look out for is what is the intention of the government, right? So because it's an economy that's controlled by the government, they have a lot of levers to pull. So like what he has mentioned, since November of last year, they have a sort of signaled that they are actually loosening up on the property. If you think about it, this thing has been something that everyone has been waiting, holding our breath for a very long time, waiting for them to actually say that. And it came much later than what was expected. Then you look at the March Liang Hui, right? Go back and take a look at it. What was being mentioned over there? This whole idea, this statement about housing, is for living, not for speculation or whatever that statement has been taken out, right? So actually the intentions are there, right? It's all written there in a way implicitly. You take a look, you know what their intentions are. Your Jan-February numbers for Resi, sales numbers were actually decent, right? Then completion numbers are also up. So take a look at that. I think December it was still down last year. Jan-Feb, there's an improvement. So I think property space, I think that is fine. Lastly, I just want to talk about banks. I agree that banks, the property side probably wouldn't have an issue. But I think I just want to draw reference to what is happening in the US, in Europe, Credit Suisse, your Silicon Valley Bank or what have you. I think that has an impact on the economies out there. So what are the impacts? There are two kinds of impacts. One is direct, meaning your companies, your investors, whoever, right? Are they invested in the ATs of these banks out there? So if we're just talking about China banks alone, I guess they have very little, if negligible, or actually is unlikely that they'll have any. So the direct impact on the banking sector in China is, I think, is very minimal, if any. Then there is the second part, which is the indirect impact. So what do you mean by indirect impact? So in US, Europe, can you imagine you're the banker now, right? Then you see, deposits flight lah, you got all these news, issues, what have you, counterparty risk and things like that. What do you do? The first thing that you do is that you tighten lending standards, correct? That means that I think the previous speaker also mentioned about that, which means that there'll be less credit to certain segments and what have you, be it tech, be it SMEs. So that impact, meaning that there's less credit going to a particular segment, could mean a slowdown in certain economies out there. But that indirect impact actually has very little to do with China. Because in China's case, right, they don't, internally the banks in China actually service their domestic economy. The foreign banks are not such a big player over there. So the indirect impact is actually fairly small. So I just want to say that, whatever that's out there, actually it's a world of two halves, right? China seems to be a little bit more decoupled from all these actions out there or negative actions out there. So in that sense, I see it as a positive. That's all.
Thank you. And that's all the time we have. Please give a big round of applause to Mr. Lim Yuin and Mr. Colin Ng. If you want to find out more about the offerings from Lion Global and UOB, they have booths outside as well. So gentlemen, thank you very much.